Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, very, very special guest, the uranium insider, the specialist in the uranium sector, Mr. Justin Hune. Always enjoy our discussions, sir. And so it's a pleasure to have you back on the channel. Disclaimer, guys, first of all, let's get this out of the way. Nothing that is said here today is or is intended to be financial advice. We are not financial advisors. We do not know your personal situation. So please, please, please make sure you do your own due diligence and take responsibility for your own decisions. Anything that we say here is a general discussion and our opinion only. Once again, it is not advice. And before I move forward, guys, if you're not already a subscriber to the Uranium Insider newsletter, I highly, highly recommend it. Personally, I am a subscriber. No, I do not get an affiliate commission or anything like that for pointing you towards the newsletter. Although, Justin, if you're going to offer, I won't knock you back on that. But guys, it's a wonderful, wonderful in-depth analysis of the uranium market from start to finish. There are quarterly options and yearly options. So I will leave a link in the description, and I highly encourage you to check that out after our discussion. Without further ado, thanking to the sponsors. This discussion is sponsored by my Substack publication, The Options Maverick. It is where I share what I do running essentially a one-man insurance company. The portfolio performance year to date is 31.2% up. So if you're looking for exactly what I do in videos, no dry theory, there's a link to that in the description also. And now let's get straight into the meat of the discussion. Justin, how are you, sir? How are you doing?
I'm doing great, man. How are you?
Very well indeed. Always good to talk commodities, in particular uranium, which is a truly peculiar beast in the commodity sector. What I might start with is I'm showing a graphic for our audio-only listeners about a demand-based case and a demand-high case and the gap between demand and supply moving forwards. What are your thoughts on the graphic that I'm showing, Justin? Is there any updates recently? This is sourced from Q4 2022. I'd like to get your general thoughts on where we are from a high level in terms of the current demand situation versus supply situation.
Sure. I would say that the biggest significant change to this particular graphic, I'm seeing this is coming from UXC's UMO, which is a quarterly product that they put out. And this, what I think this is missing, I should say, is that secondary supply is still, in my opinion, showing as significantly larger than what it is in actuality. And to clarify for those who aren't familiar, UXC is a nuclear consultant firm. Their primary clientele is nuclear utilities. And when you see this graphic showing secondary supply, what they count as secondary supply is all forms of actual secondary supply, which are typically underfeeding and tails re-enrichment from enrichers. And typically that will come during times of lower demand for enrichment. But they also include inventory drawdowns as secondary supply. So it's a little bit controversial within the industry that they actually count inventory drawdowns as secondary supply, because they count it as primary supply when it comes out of the ground, and then it runs through the fuel cycle, and it is held as inventory by a nuclear utility. And then when they draw on that inventory, they count it as supply again. So is
that not effectively double accounting?
It is double counting. When it's a very convoluted topic to get into, but essentially drawing on inventory effectively is secondary supply if you're not buying more material from the market, right?
Okay.
You've got material you purchased in the past, and rather than going to a converter and buying more UF6, or going to an enricher and buying EUP or UF6, or going to a uranium miner and buying and running it through the fuel cycle, you're actually drawing on something you purchased in the past that effectively is acting as supply in that moment, but it's still double counting. So basically the way that they operate is they have their overall demand numbers coming from the total gigawatts of nuclear multiplied by a specific calculation based on a tails assumption for enrichers. And that comes out to about 180 million pounds a year based on, 380 whatever gigawatts of nuclear in the world for last year. I'm throwing out some rough numbers here, but then they have primary supply and actual secondary supply coming from underfeeding and tails re-enrichment. And then the number that the difference between those numbers, that is the supply deficit, but that they count as secondary supply. So the inventory drawdown is secondary supply to them. And that plug number, as the guys from Sachem Cove like to call it, that plug number is the deficit. So basically, long story short, this big bump in secondary supply in 2021, that was the deficit between mined supply and demand.
Okay, but
Essentially,
that came
minus
from
underfeeding.
Okay, but that came still from utility inventory overall, right? It wasn't like new supply came
Correct.
from a mine somewhere into the market.
Correct.
Okay,
Yep.
interesting. Oh, I'm glad I
Yeah.
asked.
So that's what makes this particular chart a little bit. I don't want to say it's inaccurate. You just have to understand that context before, when you see this big bump, you're like, whoa, where'd
Wow.
that supply come from? That
Yeah.
it didn't. It was just inventory drawdown because the mined supply was less because of COVID. That had to do with two things. One, during 2020, Cigar Lake shut down for 6 months, right? So that's 9 million pounds of uranium.
Mhm.
And then during 2022, you had a lagged effect from Kazatomprom in Kazakhstan mine supply because they shut down their well field development for 6 months in 2020. So you had a little bit of less production from them. You had a little bit of less production from various mines around the world during COVID. So the secondary supply bump there actually is inventory drawdown. Primarily, of course, there was a little bit of underfeeding still happening. Then maybe you had high teens into 20 million pounds, but they're showing, what is that, like 90 million pounds for that year. So that was the deficit. That was a 60-70 million pound deficit.
Okay, that's super interesting. I've got questions specifically related to overfeeding versus underfeeding and the effective additional demand that will cause later in our discussion. I want to move again to another graphic for audio-only listeners. This is a graphic showing, I believe, contracted volumes and the spot price for yellowcake over the last, call it 20 odd years. And I've drawn a little scribble off to the side here for where we are in terms of halfway through 2023. How many pounds have been contracted? Is it around, I've got 107 million pounds for the first half of this year. Is that accurate?
That's the official tally from UXC year to date so far. There's according to UXC as well, there's a lot of off-market discussions happening. There's a lot of contracts that are kind of in the works that have yet to be inked. So we expect to see that number rise probably in the next few weeks. But yes, halfway into the year, we're almost at the volumes we saw for the entire calendar year for last year. Now, a big chunk of that volume this year so far has come from Cameco's contracts with Energoatom, and then again with the Belarusians. So you have what was it, 40 to 70 million pounds, depending on whether or not they include the Zaporizhzhia plant that's being operated by Russia. But big chunky contracts that certainly caught the attention of the nuclear utilities of the world, because Cameco is a major Western supplier, and historically they have not been the providers of uranium or conversion to Eastern European utilities. Those typically are customers of Russia. So that's a big shift this year alone, simply in a primary Western producer servicing Eastern Europe.
Okay. And so I guess a few things to point out here that caught my attention is, since let's call it 2012, this red line is my rough estimate of replacement rate per year. And we have not had a year since 2012 where the contracted volumes have been above the replacement rate. We're on track if you annualize this year's numbers. Do you think we'll get above 185 million pounds contracted in the term market this year?
I do. Yeah.
And what's the significance of that in simple terms?
Well, I think that there's definitely a lot of momentum when it comes to the way that nuclear utility fuel buyers will act within their own contracting needs. So it's just the way this industry has historically worked, and against speculation by many, it seems to be playing out the same way this cycle again. So there's a lot of utilities that have waited literally to the last minute to cover, needs that are going out, let's say 5 years from now, and it's all, the market is already extremely tight at that point. And so the significance of that is that it'll be a wake up call to any utilities that have not covered yet, in the midterm even. And they're going to have to come to the table because there's actual concerns about security of supply, that are based on, not even based on disruptions in the market. I mean, you can definitely say that what we're seeing right now is a bit of a disruption in the way that the market is bifurcated. The primary reasoning for that disruption is has been voluntary action by nuclear utilities in the West to not contract new business with Russia, but also the fact that Western enrichment tails have been rising, and that affects the amount of uranium utilities have to buy, and they know this. And so when they call Urenco and they're, we need EUP from 2029 to 2034, and they say, okay, happy to sign that contract, 0.32 tails. Utilities like, oh damn, we've got to buy 23% more uranium now than we would have had to feed into that same contract, 12 months ago. So that's a big change. And of course, these contracting cycles typically happen in cycles like you're seeing on the screen right now, where you have multiple years of close to, slightly below, slightly above replacement rate contracting after a decade of under contracting. And the only reason that decade of under contracting could happen is because we had so much above ground mobile inventory, so much excess supply. Utilities didn't have to get their needs in the term market. So they could go to a carry trader and sign a shorter term contract. They could buy in the spot market. They could secure offtakes from producers. Pretty much those options are basically off the table. There's pretty much nothing in the spot market right now. Of course, that's not a mathematically accurate statement, but there's very little uranium in the spot market, and it isn't just a static supply, right? There are producers that do sell into the spot market on a continual basis in relatively small volumes. But as far as utilities now understanding that the spot market is not a place they can go to secure uranium in any meaningful volume, means they have to come to the term contracting table. So we're very confident in this year and the coming probably 2, 3, 4, 5 years, we're going to see replacement rate and then some contracting. And that doesn't even include, the restocking of inventories. We're just talking about the actual burn rate of existing nuclear power plants. So if you factor in some of the Western enrichment cascades operating at higher tails, if you factor in, for example, the United States nuclear utilities inventories dropping by 4% in 2022, they have not even started to restock inventories. So these contracting rates are going to be very robust over the next few years. And as you can see from that graph, the big jump in term contracting that happened in 2005, that was a huge jump in the spot price as well. And so the spot price doesn't even really matter all that much to the nuclear utility world, let's say, other than the fact that it has an influence on the term market, and the term market has an influence on the spot market. And traders are sort of the connective tissue, to quote Grant Isaac from Cameco, between those two markets. So as we see term volumes rise, we're going to see the spot price jump up, and it's already started. You can see the term market volumes over the past 3 years have corresponded with the rise in the spot price. That is going to continue.
Yeah, and it doesn't stretch the imagination that we could see. Well, history could rhyme. Let's put it that way. Speaking of term markets, so we've covered replacement rates. Where do you think the term market will have to get to in order to incentivize a decent amount of new supply? Given that we have this east and west bifurcation, it doesn't appear to make a lot of sense that the eastern producers are going to be able to produce more to supply the west, given that most of their future production, it would appear, is destined to it's destined to remain eastbound. What sort of price would a utility have to put on a term contract with a greenfield developer or a shut-in mine in Africa, let's say, in order to incentivize them to come into production?
That's the $1 million question, and I think that's a moving target. But I generally can say that the supply shortfall that we can project going out, let's say 5 years from now, which in this market is basically tomorrow because the fuel cycle takes as long as it does, and the nuclear utilities are looking to cover. With that said, it's still relatively frequently right now that a fuel buyer will call up a converter and enricher and say, hey, we're looking for some material for 2025, 2026. We're good, right? And then they're surprised with the answer. No, you're not good. You're going to have to pay through the nose if you can get it at all. So the primary producers of the world right now, that's Orano, that's Cameco, that's Kazatomprom, Uranium One with their JVs, but their business in the West is basically dried up essentially. BHP sells a bit. They're essentially sold out through 2026 for the most part. So when we talk about 5 years out, if you're an investor listening to this, you don't go, oh, that's in 5 years, I might as well just sit this out. I don't think that's a wise move. So basically the last marginal pound will dictate the price. And the supply deficit is such that the last marginal pound is going to be needed. With all of that said, we can see some projects coming back online, right? So Cameco's McArthur River came back online in the later part of last year. They're moving towards significant production this year, and I believe they'll reach full production, if not by the later part of this year, next year. They, of course, brought that mine online when they had de-risked the restarting of that mine with sufficient long-term contracts in their book. Paladin is restarting Langer Heinrich. I think that's first production sometime next year with full production 2025. Not a lot of uranium there. 20% offtake going to China with a total of around 4 to 5 million pounds. And if they get that, then we have some smaller stuff coming back online. That's brownfield, Boss's Honeymoon, some US ISR projects from various companies. Greenfield, we've got Denison working on developing Phoenix at Wheeler River, very high grade ISR project. That's probably still a couple years away from first cake in the can, but they're moving towards that. So the first movers are first moving, and the price is sufficient for some of these projects. The higher grade projects, the lower cost projects are moving towards production, but nothing really happens on time, on budget. So you also can't, a nuclear utility can't really go, for example, to Denison right now and sign a contract for uranium production based on expected production from a mine that's never produced before. Maybe they can speculate with 10% of their needs in 2026 or 7 or something like that, but they got to go to the actual producers or the trusted brownfield restarts. So for example, Encore Energy is bringing on some ISR projects in the United States. They've secured, I believe it's 3 long-term contracts at this point. These are previous producing mines. They can do it.
And how much is the volume, and what sort of contract price were they able to get, to give us an idea?
Contract prices are basically all hidden under NDAs, but you can go off of their all-in sustaining costs or their fully allocated costs for production. You can make an assumption that their contracts are probably in the 50s, and they're probably, these first contracts for brownfield are not going to be as lucrative, let's say, as contracts for existing producers. Existing producers hold all the cards right now, so they want almost entirely market reference contracts because they know where the price is going, higher basically. Whereas developing projects and brownfield restarts are going to have to make slightly better deals for the utilities. So they might have fixed with floors and ceilings, for example, or like a fixed price for part of the contract, and then the market reference is going to have floors and ceilings. But when you get in, so all of those brownfield projects, Langer Heinrich and the ISR stuff in the US, Boss's Honeymoon, and there's a couple of others, that gets us an additional 10 million pounds a year, maybe, right, between all of those. And then you have Greenfield, that's brand new mines like DASA from Global Atomic. That mine is set to be producing in 2025. And that's still, a few million pounds a year. they'll be able to contract based on that, but these volumes are negligible when we're talking about utilities needing to contract 180, 190, 200 million pounds per year for the next 3 to 5 years.
Like, that was my next comment.
Yeah. So when you get to the marginal projects, you're talking about some of the dry mine stuff in the US, some of the dry mine stuff in Australia, the dry mine, open cut, open pit mines in Namibia. This is lower grade, basically at surface kind of sand, very low grades. The
So that would be
processing,
the
the
Bannermans of the
metallurgy is
world.
relatively simple, but the grades are low.
Yeah.
So, you can look at some of the feasibility studies from like Bannerman, for example, that maybe 2 years ago. This is a huge deposit, but the grades are relatively low and they need a decent chunk of capex to build the mine. That's to start, right? And then the prices they needed on a feasibility study a couple of years back were in the 70s. So we can figure, that marginal cost of production for the marginal pound is going to be probably in the 80s. But of course, if you go back to the previous bull market, they probably needed marginal costs in the 60s and the price overshot by a factor of 2. So it's really difficult to say where the price is going to go ultimately, how hard it's going to get bid up by the actual industry, let alone the financial players. So despite the fact that utilities, some of these fuel buyers that were around in the previous market have never lived down paying $100 a pound, they're going to do it again.
Yeah.
So that's what's coming basically, and the market is very thin. I can talk more about that if you want.
Yeah, absolutely. I'd love to be a fly on the wall to some of these utility contractors, the discussions about, hey, mate, remember that time 10 years ago when you paid over $100 a pound? Well, this time we're paying $200 a pound, or whatever the case may be. I think it'll be super interesting. Yeah. Any further comments before I'd like to talk about East and West bifurcation? What are the Western demand needs and where that supply is going to come from? I think that, strangely enough, I think the Eastern demand, we've got an idea. If you look at China's proposed, approved, and under construction reactors and roughly how much fuel that's going to need. Just one thing that jumped out at me was if you're looking at China's future needs, it's going to come to at least an estimate of maybe 60 million pounds per year. And if I'm not mistaken, correct me if I am, that's roughly all of Kazakhstan's production, right? So out of what used to go from Kazakhstan to the West, there's going to be a huge hole. And where is that hole going to be, or from where is that hole going to be plugged?
These are important questions. I'm pulling up my calculator right now. So they're looking at 100, what was it? 120 gigawatts by 2030.
30.
Right. So 120 gigawatts. Let's just assume 0.2 tails. So that's about 52 million pounds a year by 2030. It's probably north of 60 by the time we get to 2035 based on their plans, but just for all intents and purposes, that's where we're at.
Sure.
There was some commentary at the recent conference in Slovenia by Chinese utilities. I believe it was CNNC that made the commentary, which is they reiterated China's plan and still shooting for 120 gigawatts by 2030. So just for some context, that's a doubling of their existing fleet in the next 6.5 years. A doubling. They're at 55 gigawatts right now.
6.5 years.
Yeah, a more than doubling. So he reiterated, the person from CNNC reiterated China's build out plan, believes that they're going to accomplish that goal. He stated that China, generally speaking, will continue to seek a 1/3, 1/3, 1/3 plan, which is 1/3 of their uranium needs coming domestically, 1/3 coming from acquisitions of projects and their own mines internationally. For example, they operate the Husab mine in Namibia. That's one example. And then 1/3 will come from contracting. And I can tell you right now, they're not going to get 20 million pounds a year out of domestically out of China. Right now, they're getting about 4 to 5 million pounds a year. And they're doing everything they can to get that.
I was about to ask, is there really that much uranium in China?
There's not. I mean, in very low grades. And to be fair, there's a ton of uranium and phosphate tails, and China has most of that. So, but it takes $200 a pound to make that cost effective to extract that. So it's not a near-term solution for them. Maybe a long-term solution. And eventually, I mean, when we start talking about sustainable prices, sustained prices in that ballpark, options open up, right? And we're talking about getting uranium from seawater and phosphate tails and things like that. But we're a long ways away from that. And I don't know necessarily that demand from the industry is going to take us to $200 a pound and it's going to stay there. That's probably a little bit of an overshoot. I really think the industry needs between $80 and $100 a pound sustaining. But it could spike to that. I just don't think it's going to stay there. So they're not going to get a third of their needs from domestic. It's just not going to happen. I don't know why they keep reiterating that statement, but they do. As far as where is it going to come from, it's probably going to come from further acquisitions. Most likely that's going to happen in possibly with more mines out of Kazakhstan as they expand, potentially Uzbekistan, but most likely it's going to be African acquisitions. So probably in Namibia, they're already established there. Do they take a whack at Niger? I don't know. The French are pretty firmly established there. And then contracts, CNNC's announced contract with Kazatomprom. We still don't know the volumes on this contract, but we know they were sufficient to require a shareholder vote to approve it because it was greater than 50% of Kazatomprom's book value.
Okay.
Now, a caveat here is that the total contract value for CNNC with Kazatomprom would be greater than 50% of the book, not necessarily this one contract that was under discussion. So we still don't know how much that is, but it's big. So despite the fact that they have the largest inventories in the world, despite the fact that they're operating a big mine in Namibia, they've got offtakes from Rossing and Paladin's Lanker Heinrich. They have a bunch of JVs with Kazatomprom. Most of about half of the uranium coming out of Kazakhstan, Kazatomprom, about half of their production is going to China. They're continuing the contract and they're continuing to signal that they will be doing more of this. So they're not blinking on this, and the Western world is going to have to wake up, and they're going to have to do it soon.
Interesting. So maybe Brandon Munro will be able to sell his deposit to the Chinese, like many have speculated.
It's possible. They really struggled with developing Husab. They really did. They spent way more money on it than they were planning. They've had a ton of problems with it, but they are producing now, I think, north of, somewhere in the realm of 12 to 15 million pounds a year coming from Husab. So I guess it would be safe to say that they've figured out, the metallurgy there. And I think that there will be some takeouts in Namibia, in my opinion.
Okay. I've heard you talk about in other podcasts about the amount of uranium demand or the uranium supply that could be lost to the West. And so in summary, is it the case that, let's say, the US, about 20% of their supply current supply comes from the East, but it appears that Rosatom is trying to, they have their reactors and they promise to supply the fuel to those reactors. I'm more interested, where are Russia going to get their supply from? Because they, from what I understand, have essentially promised to provide twice its current domestic production. Russia's not exactly on the best friends list for other nations around the world. So where are they going to get their uranium from? Is there going to be a fight for uranium out of Kazakhstan to make up for, I guess, China's needs and Russia's needs?
Yeah, I think so. So just to clarify one point that you made, the US's needs about 20%, a little bit more than 20% comes from Russia specifically. It's far more than 20% coming from the quote unquote East. So they purchased more uranium from Kazakhstan in 2021 than in any year in the US nuclear history. So they get way more than half of their uranium from the East, from Kazakhstan and Russia combined.
Is that enriched uranium or it's just yellow cake?
Kazakhstan would be U308, and then most of the uranium that comes from Russia to the US is enriched uranium. Yeah.
Gotcha.
And so and Russia will get the best. Russian uranium assets are joint ventures with Kazakhstan. They do have a handful of mines in Russia. Mine number 6, I believe, is operating or close to operating. There's and then this latest one, this Budanovsky, the block 6 and 7. This is the most recent mine to be developed by Kazatomprom, and it's a monster. It's a very, very big ISR deposit, and the sovereign wealth fund of Kazakhstan, which is the majority shareholder of Kazatomprom, they own 70% of the shares of Kazatomprom. They pushed through a deal for Rosatom to own 49% of this new deposit. And what we now know in hindsight is that the management of Kazatomprom was largely against this happening. And a lot of them left the company after it got pushed through by the sovereign wealth fund. So this is something I think investors completely overlooked, and is adding a lot of risk to Western utilities, because this historically friendly jurisdiction to the West that's provided very reliably abundant and cheap uranium to the EU and the US for a decade, is now pushed through a deal for their latest mine to be 49% owned by Russia. And I don't know what the long-term or even short-term implications of this are going to be, especially if Russian uranium is officially sanctioned in the US or the EU. So it's messy. It's become a very messy jurisdiction, and that is a problem. That is a problem, a big problem for utilities in the West. They don't like jurisdictional risk. Okay, security of supply, when it comes to it, is 100% paramount. Price is important. Price matters. So when you hear people say, "Oh, uranium is only 4% of their operating budget," it's not a big deal if uranium goes from $35 to 100. It's like, yeah, that's not exactly true, because uranium doesn't go up in a bubble. And so for all of the elements of the fuel cycle, all of those prices rising, that affects the bottom line of utilities. When those utilities have to compete in the open market, in certain markets in the United States, for example, with subsidized solar or natural gas for that matter, then it matters, right? So price matters, but you can't not have fuel for a multi-billion-dollar asset that's crucial for the energy security of a country.
It's a very expensive paperweight for sure. Yeah.
Very expensive paperweight. Yeah. To quote our friend Cuppy.
Yeah.
So yeah, it's not an option to not fuel these things. That's just not an option. So when you have jurisdictional risk, you have to focus elsewhere, and the options elsewhere are basically Cameco and Orano in volume. Then you have these smaller producers that they've been going to, been getting some offtakes from the Uzbeks, and they get a little bit of production out of Africa, a little bit of selling from the Chinese. But like I said, the Chinese are net buyers. BHP at Olympic Dam is still selling some uranium, probably going to increase their production of uranium in the coming years. So that's
all that stuff is essentially chicken feed when we look back to that replacement rate demand graphic that I showed earlier. Right. So yeah, and I mean with Kazakhstan being, I guess, obligated under their treaties with, I forget the exact name of it, but essentially it's the inverse of NATO with Russia and all their friendly nations.
CSTO.
CSTO, that's the one. Essentially, they're not going to be able to, if push comes to shove, they're not going to be able to refuse Russia's interests.
Yeah. I mean, and a couple more details on that. You're absolutely right, by the way. So we have a contact who's very deep into the weeds in terms of boots on the ground in Kazakhstan and understanding the geopolitical elements of that area of the world. And basically what's been going on in Ukraine officially has been a special military operation. And if it turns into an actual declaration of war, to your point, the CSTO countries are essentially obligated to support each other in that instance. So that's Kazakhstan, which makes it even more problematic, obviously, on the nuclear front. The other thing I wanted to mention was there's two bills moving through Congress in the United States to sanction Russian uranium in various degree, and they do have waivers available for nuclear utilities to continue to accept deliveries based on legacy contracts. But it either has to be they literally have no other option, or B, it's determined to be a national security problem if they don't get that uranium. So
I think it may be 2 from 2. That's quite the loophole there.
Right, exactly. So there's a little bit, it's kind of vague, right? So who gets to determine if it's a national security issue? What does that mean? Do they literally have no other options? Does budget influence that? So if it's like, oh, hey, we can take this delivery of Russian EUP for $30 a pound equivalent, but if you're going to cut us off, we got to go buy it at $150 a pound, or whatever it is, or
Yeah.
not quite that much, but double, right? They'll have to pay double to get it fast from somewhere else. But I think one of these bills is likely to pass. I do actually believe that. And I also think it's greater than a 0% chance that Russia, not preemptively, but in response to that passing, cuts off entirely, entirely sending shipments to the US of enriched uranium. So if that happens, if either of those things happen, we're going to see a response in price, and we're going to see probably a response in the equities as well.
Yeah, definitely want to. I know you got a hard stop, so I'm going to move right along. Before we get to equities versus the physical, I wanted to touch on the point you made about overfeeding and underfeeding. When you take into account the change in tails assay and the change from under to overfeeding, can that really create 40 to 60 million pounds of additional demand annually? This is
So
from what I've read, and I wanted to check and get your thoughts on this.
So that's a pretty big number. I wouldn't put it that high. But that number, what that number I believe is reflecting is a total swing. So that's including the
Gotcha.
reduction of underfeeding plus the addition of overfeeding, kind of as a combination number.
Okay, so you'd
So
take what was, let's say, for argument's sake, 20 million pounds of effective supply when you're underfeeding, and then now that becomes excess or effective demand when you're switching into overfeeding.
yes, yeah, exactly. I mean, it's in a similar way. It's kind of like Cameco shutting down or putting on care and maintenance MacArthur River. They had to be buyers in the market, right? So not only were they not producing, they were buying. So it has kind of a doubling effect. So the 20, let's call it 20 to 25 million pounds globally annually, and that's globally. That's globally.
Okay.
So the overfeeding, not the overfeeding. Let's leave that next. The lack of underfeeding is specific to
Gotcha.
Western enrichers, not all enrichers.
I see.
So Russia still has 40 something percent of global enrichment capacity. They haven't had any reason to raise their tails. So they're probably continuing to underfeed. It's just that uranium is not going into the Western market, only on legacy contracts. And that's pretty difficult to actually track that. So Western enrichment is about 40% of the global total. So you can figure, let's say 25 million pounds, you can figure 10 million pounds of underfeeding is gone. And underfeeding in the West is gone. That's not rhetoric. That's not happening right now. So 10 million pounds coming from Urenco and Orano is not there. That was there 2 years ago, 18 months ago. And then overfeeding is a little bit hard to calculate because between those two primary Western enrichers, not all of their centrifuges are operating at higher tails. And you also have what you have to consider is not only the operational tails assays of the enrichers and what they're actually spinning in their centrifuges right now. So some of that has risen from, let's say, 0.18 to 0.2 to about 0.24, 0.25, 0.26. Some of these Western cascades have bumped up about that much.
Still a significant increase.
That's a significant increase. So that's probably about a 10% increase in uranium demand. And the enrichers that are overfeeding, they are covering. They have to buy conversion and or UF6, and they've got to buy uranium if they can't find the UF6 to get it converted. And that is happening. So Western enrichers are buyers of conversion in uranium. That is happening. They're competing with utilities, okay? That hasn't happened in the last 15 to 20 years. Happening now. So the operational tails is a bit of a bump, right? And that is limited to conversion capacity, which is limited right now as well. So they can't just take all of their centrifuges and bump them up to 0.25 and then go out and buy a bunch of UF6. A, there's not any UF6. B, there's insufficient conversion capacity to buy the hell out of uranium and flow it through the converters in the West. So it's incremental and it's minimal right now, but it's something. So let's take 10 million pounds underfeeding gone. Let's say Western capacity for enrichment and an increase of some of the cascades is, let's be conservative and call it 5 million pounds of increased demand due to actual overfeeding of enriching of centrifuges right now. And it's probably more than that. We can probably say, let's say 5 to 10. But what you have to consider primarily, and this is really where it gets juiced up here, is the transactional tails assays. And like I mentioned earlier, if you're a nuclear utility in the West and you call up Urenco and you say, hey, I want some enrichment from 2030 to 2035, you're going to be signing a contract in the 0.3s. So that means that nuclear utility that's signing an enrichment contract for the later part of the decade and beyond, they're going to have to buy a hell of a lot more uranium to feed into that contract. Now, that doesn't mean that's demand today, but it could be demand 6 months from now, 12 months from now, 24 months from now. It's demand either way, but the fact that the tails are so high in these contracts, these new enrichment contracts in the West, that's a big swing. So hard to really put hard numbers on this, but 40 to 60, that in my opinion is too high and not happening right now. I would say we're probably 15 to 20 million pounds this year in increased demand coming from overfeeding and lack of underfeeding. And that's just going to climb as the years go by. So let's say 3 years from now, we could be seeing probably a 30 to 40 million pound increase in overall demand coming from this element.
Okay, still significant. Glad. Thank you for the clarification. Glad I asked.
Sure.
Moving right along into the financial aspect of this trade, what's the, or when are we going to see the commercial buyers? They panic, and then they're going to have to make make good on some of their needs by dipping into the spot market. Traders know this, and they're going to front run or chase that momentum, leading some reflexivity to the upside purely from the financial markets. In addition to which, we now have a proliferation of physical acquisition funds, which, Spot, as we know, when it trades at a premium to NAV, they can issue and go into the market. The Zuri Invest, from what I understand, they just keep buying. They just got an amount and they just keep hitting that, come what may. What are your thoughts on the financial markets? I guess with your closing comments, and then we'll talk about the equities that you get access to inside the Uranium Insider.
So this might be one of my favorite elements of this trade, because it's just kind of that exciting X factor that you cannot model, right? So nobody knows how much uranium Spot's going to buy this year. We got 6 months left in the year. Risk has primarily been off in the equities markets. They've been at a premium to NAV for less than, I think, 5 days out of the year so far.
Yeah.
They've only bought, what did they buy? 1 million pounds, I think, back in February, and 100,000 pounds in March, and that's it. But it can come back on at any time. And the important and crazy part of this is that you don't need financially driven secondary demand in your supply and demand model to see massive shortfalls going out into the future.
Yeah, as we've just established, but this financial demand can be like rocket fuel on this tinderbox, right?
Yeah, exactly. And so, Zuri was doing some buying earlier this week and last week, and we saw a multi-dollar move in the spot price based on relatively low volumes. So we actually saw a $3 move in the spot price on less than 1 million pounds purchased. I don't know that all of that came from Zuri's purchasing, but less than 1 million pounds purchased in the spot market caused a $3 move. Leading up to that,
tight, boys.
It's tight,
It's
and
tight.
I can't get too deep into the weeds with this, because I don't want to share something that I'm not supposed to share. But basically, it's so tight that a fuel cycle service provider, let's just say, was attempting to respond to an RFP from a utility. So in a request for proposal. So in some cases, a utility, when they have needs, especially when they're shorter term needs, if you're looking at a long-term contract, typically a utility will go and may have a conversation directly with a producer or a developer. But if you have shorter term needs, oftentimes you'll put out an RFP into the market just to get as many offers as you possibly can. And then you can decide which offer you want to go with, and you sign that deal, right? So this RFP went out looking for either UF6 or EUP because the needs are relatively soon, 2024 to 2029. And a fuel cycle service provider, that's as detailed as I'm going to give you.
Justin, it's just us, mate.
Attempted. It doesn't matter who it was. The point is, will be very clear. They wanting to respond to this RFP for this utility, and in doing so, they had to put out their own feelers for uranium, their own RFP for uranium to run through the fuel cycle to be able to provide what they wanted to provide, right? That was, UF6 or EUP. They went out for somewhere to the tune of 2 million pounds, and they got 3 offers back, and those offers were less than 50% of what they needed. And my understanding is that this is an industry first. This doesn't happen. 12 months ago, you put an RFP out for 2 million pounds of uranium for 2025, 2026. You get filled, and you get filled quickly. This is new. This is how tight things are. So when you have that level of tightness in the physical market, and you understand that there are 4 currently, right? What do you have? Yellowcake, Sput, Zuri, and I guess Annuum Energy is not buying yet, but they're raising cash still. They're still in the fundraising element. They'll be kind of, I think it's Q2 of next year. Plus we have at least 3 other physical funds in the works currently.
Yeah.
So all of these funds are set up literally to take capital flow and buy uranium, and there's basically no uranium. So I really don't know what price discovery looks like in the spot market, especially for what Zuri is doing for front month settlement. What happens when capital really flows into this sector, and whether or not that happens, we have an unbelievable fundamental thesis to be long this sector. This is just the nitro. This happens. This is the gasoline on the fire, and it's the X factor, and you can't model it. Nobody knows how much is going to flow into the sector. Nobody knows how much buying they're going to do, but it's going to be something. And when it happens, it's going to be quite the sight to see, in my opinion.
Yeah, I tend to agree. I can't argue with that. So we've spoken about the supply demand fundamentals, the geopolitics, the updates in terms of the physical conversion and all the stops along the train line of the fuel cycle. And we come to the conclusion that term and spot prices are rising, and they're going to rise quite a lot higher. And yet when I pull up I'm just using URA because it has the longer history, the ETF divided by the price of the futures, which I'm showing on the screen for audio only listeners. This is one of the cheapest times in history when you value the equities relative to the commodity that they produce and sell. What gives?
The fastest rate hiking cycle in the history of markets in the last 12 months, and just general risk off, I would say. Preceded by what was now pretty clear in hindsight, an overbought situation for uranium on your chart there. They were looking out towards the later part of 2021, right? Yeah. Autumn of 2021, things were pretty overheated. So we've seen a big pullback, and part of that, I would argue, was due a nice healthy pullback. And I would say that that's been extended by just general risk off markets, lower liquidity, higher interest rates, et cetera. So uranium stocks are still stocks. So they don't move in lockstep, but in the big picture, in the long term for this investment, we believe the equities will move directionally with the uranium commodity. And generally speaking, they have, but yeah, you're right. They're not far off even the COVID lows in terms of equities valuations relative to the price of the commodity. Incredible value proposition.
Yeah, I tend to agree. Final couple of questions. What do you expect? Historically, what's the beta on the producers, developers, explorers versus the underlying commodity? So if we're expecting, I don't know, let's call it a doubling, no, let's not do that. Let's say spot price gets to $80. What kind of beta do you get with the miners in uranium? I know general rule of thumb with gold or precious metals, you get maybe a 3 times beta from the producer versus the underlying commodity. Got any thoughts on the beta of the uranium producers versus the underlying commodity itself?
I would say that that general 3x is probably pretty close. The large caps might be a little bit less than that, and of course, if you have a small cap explorer that hits something good during the bull market, they can have 10 to 20x or whatever it might be. But on average, I would argue that there's probably 2 to 3x and possibly more, just general leverage in uranium mining equities to the commodity itself. And that's of course when the sector is moving really strong. We're in a robust bull market for equities and the commodity. Risk is on. So lately, the performance of SPUT, even at a persistent discount to NAV, has outperformed most of the other uranium equities.
Yeah.
And that's basically just moving up with the price of uranium while risk has been off for the market. So, but we think there's going to be a big period of catch up for the equities compared to the metal.
Yeah, and my personal opinion with the recent pause in rate hikes, it's not a pivot, but it's a pause. Potentially some more liquidity flowing into the sector. To your point, last cycle, the large caps such as Cameco, obviously going from peak to trough, $4 to $60. That's a 15x on a large cap. So that's not too shabby. And small caps such as Denison from 30 cents all the way up to $15, so a 50 bagger. To reference, to give us, I guess, an idea of historically speaking, what a reference point to that beta might be. Guys, wrapping up now, the Uranium Insider Letter, link will be in the description. I highly, highly recommend that you check it out. Justin, any final thoughts? Anything I've missed that you would like to add in terms of commentary before we wrap it up?
I honestly think we covered it pretty well for a relatively shorter chat. I think that we've got it out in front of us here. We have typically a slower period for the uranium market. Usually, the later half of June into July and the first half of August for about a 2.5 month period is usually a slower summer period. However, what we're hearing from straight verbatim from the nuclear fuel consultancies like UxC and Trade Tech, basically saying, usually the summer months are slow. We don't believe that's going to be the case this year because of all of the elements that we just discussed. So it's entirely possible we continue to see a rising price environment throughout the slow summer period. And gosh, the equities are so undervalued relative to the metal here. I don't know what's going to happen in capital markets. I don't know what's going to happen in the equities markets, but I can say with very, very high confidence that uranium is heading higher. And we discussed, the thinness of the market and just the fact that these funds are being set up. And I don't think these physical funds are being set up for no reason at all. So, typically these funds are built when there's an understanding that there is investor appetite for such a fund. So I'm excited to hear about hear more about the few that are in the works. But they're not even needed. They're not needed. It's game on for utilities right now, and that's the most exciting thing for me.
Yeah, I share your excitement. So thank you very much for your time. Guys, leave your comments and questions in the comments section. And then in our next chat, whenever that will be, we will delve into the weeds and pull on a few of the threads. Thank you very much for listening to the ROI channel. Reminder, Uranium Insider link in the description. I know you're all wondering, well, which stocks should I be looking at? And that is exactly what Justin's private subscribers get access to. So please do check that out. Other than that, thank you very much for your time, Justin. I look forward to catching up with you in another video shortly. Guys listening, take care, and I hope to see you back in our next video.